Okay, thank you, Phillips. And first of all, I would like to thank the organizing committee of this conference for inviting me to this very nice program. This is a joint work with 3 other economists at the Federal Reserve Board, Lamont Black, Ricardo Correa, and Hao Zhou. So the usual disclaimer will apply. So this paper studied the systemic risk of the European banking system. So as usual, the motivation for this paper, the recent financial crisis started thinking about the systemic risk. What Europe is experiencing now is not only the conventional financial crisis, but also the sovereign debt crisis. The European banking system is a major player in the world banking system, and different banks in different countries and regions have become more and more interlinked nowadays. So a systemic event in the European banking system will have global implication. Our paper is written against this kind of background and consistent with the recent macroprudential approach, which is also a thing in the Basel III. So the macroprudential approach is in contrast with the more microprudential approach. That is, the macroprudential approach focuses on ensuring the stability of the whole system as a whole, while the microprudential approach focuses on the ensuring the stability of each individual banks. The lesson from the recent financial crisis show us the insufficiency in the traditional microprudential approach, and we really need to take the whole system into consideration when we designed the policies. So against this kind of background, several interesting questions can be asked. First, what is the value of the systemic risk? And what does the systemic risk look like over the time? That is the dynamics of the systemic risk. The other one, there are many driving factors underlying the systemic risk. What is the main driving factor over different period of time? They may change. So in our paper, we consider several different kind of driving factors. One is the actual default risk, the physical probability of default. And the other one is the people's attitude towards the risk, including the default risk premium, the liquidity risk premium, and more recently, a new type of risk premium, the sovereign risk premium. And we will see that they play different role in different period of time in our sample. And thirdly, although the macroprudential approach is phrased at the level of a whole system, but the banking regulation has eventually to be implemented at the level of each individual banks. So it's very important for us to identify the banks that contribute the most to the overall systemic risk. That is, the banks that are systemically important financial institutions. And finally, as Phillips mentioned now, many different measures for systemic risk have been proposed in the literature. So it will be interesting to compare our empirical result with those of other systemic risk measures to see the similarities and differences. So before we go to the methodology, let's first take a look at our sample. So we take 58 major European banks, and they are big banks in the sense that their total assets take up a good portion of their own country banking system, as shown in this table. And let's just focus on one number, that is the share of our sample banks in the overall European banking system. It's about 58% in terms of the total asset, okay, which is quite big. And then from the sample selection perspective, we start our sample selection from the 90 major European banks included in this stress testing exercise conducted by the European Banking Authority in July 2011. Due to data availability, we shrink our sample from 90 to 58. And then this table gives the descriptive statistic of the raw data we use in our empirical study. First of all, for the convenience of study, we categorize the banks into different groups by their similarities. For the relative large countries like France, Germany, Great Britain, and Switzerland, we sort them into single country group. And then for the relatively smaller country, like Austria, Belgium, Luxembourg, Netherlands, in group 5, Denmark, Norway, and Sweden in Group 8. For the peripheral countries, we saw them into two separate groups. Italy, Spain into Group 6. Greek, Ireland, and Portugal into Group 7. And then, relatively speaking, the French and Great Britain banks are larger than the rest of the country banks, either in terms of the total equity or total liability. How about the riskiness of the banks? We divide our sample into 3 different periods. Period 1, pre-crisis period. Period 2, the financial crisis period. Period 3, sovereign crisis period. We will see the detailed timing of the 3 periods later on in our time series plot. Now here, let's just focus on the average CDS spread for those banks. We can see that for the pre-crisis period, everybody enjoyed very low CDS spread, safe. And then all of them experienced significant increase in their average CDS spread during the financial crisis period. It can be 10 times. And then from the financial crisis period to the sovereign debt crisis period, well, the increase is somehow, but not very significant, except 2 groups, Group 6 and Group 7. Their average CDS spread, either double or quadruple. So this is the difference between this group and the rest of the banks in our sample. All right, so this is the description of the raw statistic. We are going to use this raw data set in our empirical study. All right, so let's first talk about the concept of our systemic risk measure. We call it Distress Insurance Premium, DIP. And the definition of this measure is, first, we construct a portfolio which consists of all the liabilities of these banks. And then we imagine there is a hypothetical insurance contract to protect this portfolio of liabilities. The fair price of this insurance contract, the insurance premium of this insurance contract, is our systemic risk measure. So intuitively, the higher the risk of this portfolio, then the more expensive this insurance contract would be. So we will use the price of this insurance contract to measure the riskiness of this portfolio of liabilities of major banks. So this is the flowchart outlining the steps involved in our computation of our DIP measure. First, to compute the overall system risk, we need to know each individual bank's risk. So we use the single name CDS spread for those banks to back out the probability of default for each individual banks. And then, to put all the banks together, we need to compute a measure for their interconnectedness. So we use their equity price data to back out the correlation among different banks. And then, with each bank's probability of default and their interconnectedness, we can put them together to simulate the default scenario for the portfolio of liabilities. And then we discount the default value in the future to the present. And by market clearing condition, the current expected future loss will be the fair price of the insurance premium. And this is our indicator, the DIP. Let me just go a little bit into each individual step and focus on the intuition here. First, to back out the probability of default for each individual banks from their single name CDS spread. The idea here is the CDS spread is approximately the product of loss given default and the probability of default. And then from the market data set where we obtain the single name CDS spread, we also have the loss given default reported by the traders. And then we can back out the probability of default using the data on CDS spread and loss given default. Here, SIT is the CDS spread, LGD is loss given default, and PD is probability of default, and I is the index for the bank, T is the time index. AT and BT are parameters in the computation. They are functions of the discount rate and the time to expiration of the CDS contract. Now, the property of this probability of default are twofold. First, the CDS spread in essence is a market price. Market price, of course, naturally is forward-looking. So the probability of default back out from the CDS spread is also forward-looking. It gives us the future probability of default instead of the historical probability of default. The other one, in this computation, we use the risk-free rate as the discount factor. So the probability of default back out from this computation is risk neutral. In other words, it has different components. One is the physical probability of default, the actual default probability. The other one is the people's attitude towards the risk premium, including the default risk premium, liquidity risk premium, and more recently, sovereign risk premium. Later on, we will have different proxies for these unobservable risk premiums in our computation. Second, to compute the interconnectedness of different banks, ideally, we would like to compute the correlation of total asset. However, the asset data is available at low frequency, like a quarterly frequency. We would like our indicator to respond very quickly to the changing market situation. So instead of using the asset data, we use the equity data, the stock price, which is available every day. And of course, the equity return correlation is a good proxy for the asset return correlation only for very short horizon, but this is exactly our purpose, to respond very quickly to market situation. And we further adjust the correlation matrix by some econometric method to ensure that our correlation matrix is positive, semi-definite, that it makes sense econometrically. And then with the input of the probability of default and the correlation, we can go to step 3, together with the liability, which is the component of our portfolio, as well as the risk-free rate, loss given default, to simulate the default scenario. And then the total loss of our portfolio will be the sum of each individual bank's loss if they default. And then our DIP measure is the discounted expected future loss. Of course, we are not considering all possible loss. We are creating a mirror image to the systemic risk, which is the big loss. So we need to cut off the loss over the certain threshold. Here, our threshold is set at 10%. You can try 50%, other threshold as well. It will not affect the dynamics, only the level. Okay. So this is the end of the methodology discussion, and let's go to the empirical section. All right. So first, this is the time series plot of our DIP measure. We have 2 panels. The top panel is in percentage. The bottom panel is in billion euro. So they're just different measurement unit, but the same dynamics. You can see that for a long period of time before the start of the recent financial crisis, the overall European banking system enjoyed very low systemic risk, only a couple of basis points. And then we see 2 major surge in our systemic risk indicator. The first period is from summer 2007 all the way to the end of 2009 or early 2010. We can think of this as the financial crisis period. And then from the summer of 2010 all the way to the end of our sample, which is February 2012, we see another surge of our indicator. Now, let's zoom into these 2 periods separately and see what are the economic events behind this. So first, the financial crisis period. The first major event is PNP Paribas froze fund, which signaled the start of the subprime or mortgage market crisis in August 2007. That's the first little peak of our DIP measure. And ever since then, it kept going up and reached the first peak in March 2008 when Bearston was acquired by JP Morgan Chase. Then due to strong government intervention, the DIP measure dropped. But ever since the second half of 2008, it started increase and then reached the second peak right after the failure of Lehman Brothers. And then it stayed at a high level and reached the peak in our financial crisis period, which is March 2009. That's the bottom of the US stock market. This is the European banking system, but similar, I believe, in terms of the stock market performance. And then in April 2009, the G20 held its summit, and in May 2009, the Federal Reserve released its, or US government released its first stress testing result. And then our DIP measure calmed down. Okay, this is the financial crisis period. Now, how about the sovereign debt crisis period? In May 2010, Greece signed the first bailout agreement with EU and IMF, and this started the sovereign debt crisis period, and our DIP measure raised to a higher level all the way to summer 2011, when market was concerned about the spillover effect from the Greek bank to the rest of the European banking system. So our DIP measure keep climbing all the way to the highest level in our sovereign debt crisis period, which is also the highest level in our whole sample. That's the peak, we think, of our sovereign debt crisis period. And then the ECB extend its liquidity provision through a dollar swap line with the Federal Reserve in the US, and also its first 3-year long-term refinancing operation. And this measure effectively calmed down the market, and our DIP measure reduced. I believe this is consistent with the early result that Peter mentioned. All right. And then this table gives us the relative explanatory power of different computational input in computing the DIP measure. We use the probability of default and correlation to compute the DIP. So after we get DIP, then we would like to know how much of the change in DIP is explained by DIP and how much is explained by the, explained by probability of default and how much is explained by correlation. So here, the average probability of default is a good variable in explaining the variability of our DIP measure. The R-square is as high as 95%. Correlation by itself is also significant. The in parentheses is the t-statistic. But the explanatory power will not be as high as the probability of default. So we can think of the correlation as a secondary importance. And then in the final regression, we put everything together, including probability of default, correlation, recovery rate, which is 1 minus loss given default. And also the dispersion in probability of default, dispersion in correlation, which measure the heterogeneity across different banks for their probability of default and correlation with the other banks. So interestingly, we see that the dispersion in probability of default, which is not explicit into our computation of DIP, also has a significant explanatory power, and the sign is correct, which is negative. So the higher the dispersion in probability of default, the higher the chance for diversification, and the lower the risk of the portfolio will be. All right, and then our original computation is based on the CDS spread on the senior debt, which is the red line here. We can do the same computation using the CDS spread based on the subordinated debt. Originally, we used the senior debt just because it's the most heavily traded CDS contract, so the information is very rich. However, there is this kind of concern that is the government provide guarantee to those banks. So the risk of the senior debt actually decrease. So if we compute the DIP based on the senior debt, we may underestimate the risk. But the subordinated debt is not so much guaranteed by the government. So it fully reflects this kind of risk. And the difference between the senior and the subordinated debt DIP measure will give us the effect of the government guarantee. Okay, so you see the effect is changing over the time. Maybe small during the financial crisis, but definitely big during the sovereign debt crisis period. The other one is in our DIP computation, we use the probability of default back out from the CDS spread. The probability of default back out from the CDS spread is risk neutral. It contains both the actual probability of default and people's attitude towards the risk. How about we just use the actual risk, the actual probability of default to compute our DIP measure? Well, we cannot use the CDS spread for sure. So yeah, instead we use the expected default frequency provided by Moody's KMV. So this is the physical probability of default. And the difference between the two measures give us the people's attitude towards the risk. So here, we can see that the risk premium plays a big role in financial crisis period and the first half of the sovereign crisis period. But as we go into the second half of the sovereign crisis period, actually, it's the actual probability of default that become important in determining the systemic risk. The risk premium becomes less important, but still. So there are different types of risk premium in this, the distance between the red and the blue line. So we further decompose them into different components and see how their importance change over the time. So here, the bottom part is still the EDF. And then we use the BAA-AA spread for the European industrial 10-year bond to proxy for the default risk premium. And then for the LIBOR OIS spread to proxy for the liquidity risk premium. And then the spread between the German 10-year sovereign bond and the average of the Spanish and Italian sovereign bond to proxy for the sovereign risk premium, which is relatively new recently. And then we see that during the financial crisis period, it is the default risk premium that is the main driving factor of the overall systemic risk. However, as we go into the sovereign crisis period, it's the sovereign risk premium that becomes the main driving factor, as well as the increased importance of the actual default probability. And then, in the interest of time, let me just go into this plot. That is the decomposition of the overall systemic risk into the contribution of different groups. So here we see the first group. This is the French bank. They are always a major contributor to the overall systemic risk. The German and Great Britain bank see increase in their importance during the financial crisis period, but their importance decreased relatively during the sovereign crisis period. In contrast, the Italian, Spanish, Greek, Ireland, Portugal, these peripheral countries, their banks are not major players during the financial crisis period. But as we go into the sovereign debt crisis period, their importance increased significantly. So these peripheral country banks as a group become more and more important systemically. And this is the bank level, individual bank level, and let's compare our result to the other two measures, the S-risk and CoVR, both for the peak of the financial crisis period and the peak of the sovereign debt crisis period. And this table is sorted in the order of our DIP measure during the peak of the sovereign crisis period. We can see that the three measures approximately agree with each other. Of course, all of us use market data, although we use credit market data and as well as the equity market data, and these two measures mostly use the equity market data. Now, we would like to make a further comparison of our DIP measure with the result of the regulator. This is the GCV Bank released in November 2011. We can see that those banks that are identified as GCV banks are also top on our list. Okay, so even if we use completely different data set, they have more confidential regulatory information while we fully relied on publicly available market data. However, results are consistent. So the major contributors, according to our measure, are also identified as GCV Bank, with only two exceptions. One is our sponsor of this conference, the Intesa San Paolo in Italy. The other one is BBVA in Spain. So they haven't been identified as GCV Bank according to the international bank regulators, but according to our measure, they are big players in the European banking system. Okay, so let's skip this and go to the conclusion. All right, so the European banking system reached its highest level of systemic risk in November 2011. That's the sovereign debt crisis period. And the main driving factors underlying the European banking system systemic risk include the actual probability of default and the risk premium of the sovereign risk. And relatively speaking, the Italian and Spanish bank have become systemically important according to our measure. And this, I have to skip that. And finally, for the policy implication, our empirical result support for something like a European banking union with centralized macroprudential regulation so that the banking authority in the European country can synchronize their effort in stabilizing the whole banking system. Thank you.